You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Thanks for joining us today. Here at OIC, we've been making a big push to increase the education we're providing you. We recently added a panel discussion with industry professionals to our monthly webinar schedule. This panel discussion follows the previous week's webinar that focuses on the topic of the month at OIC. It turns out those panel discussions make pretty darn good radio, so we've decided to offer them to you here as well. In this panel discussion, we're going to talk option Greeks. We hope you enjoy this format, and please let us know what you think about it by sending your feedback to options@theocc.com. Thanks a lot, and hope you enjoy it.
Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, What Greeks Can Teach You About Options, we'll build on the 5 options Greeks with a panel discussion featuring 3 experienced professionals. Our moderator for today's panel is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of options and investments to our discussion. Today's panelists include Steve Claussen of Options House, Bo Nobel, an OIC instructor representing the MIAX Options Exchange, and Dan Passarelli of Market Taker Mentoring. And now, ladies and gentlemen, Joe Burgoyne will introduce our panelists for today's topic, What Greeks Can Teach You About Options. Joe?
Hey, Nick, thanks so much, and thanks to everybody for joining. Nick said 3 experienced traders. Boy, he wasn't kidding. I mean, we've got Bo Nobel, as Nick said, retired options trader representing the MIAX options, over 20 years experience. Steve Claussen, chief investment strategist at Options House, well over 20 years experience down on the floor at the Chicago Board Options Exchange, as does Dan Passarelli, the founder of Market Taker Mentoring. So, 55 plus years years of on-floor trading experience and that kind of wisdom we're going to bring to you over the next 50, 55 minutes or so. So in just a sec, I'll bring those guys in. But as everybody knows, the industry does have a document called Characteristics and Risks of Standardized Options. For those of you who might be brand new to the option space, please be sure to get a copy of this from either your broker or the OCC. Many of you, typically about 35% of our attendees are first-time OIC attendees. And for those of you who don't know, the OIC is the educational arm of the options industry, funded by the OCC, which is the clearing corporation, and the 7 parent companies, the 14 exchanges. The OCC, by the way, is the world's largest equity derivatives clearing organization and the foundation for secure markets. These are the 7 parent companies that comprise the U.S. listed options universe. And for those of you who have heard me before, you know this is one of my very favorite slides. The picture of industry growth in the options business starting in '73 in Chicago, now on the 14 exchanges. We trade over 4 billion contracts a year, which breaks down to close to 17 million contracts a day. So with that, it is time to bring in Bo, Steve, and Dan. And I think I'll start with Dan because, Dan, you wrote a book and the book, Trading Option Greeks, How Time, Volatility, and Other Pricing Factors Drive Profits. Tell me what are the Greeks, Dan? Get us started.
Sure, thanks, Joe. The Greeks they're the single most important analysis tool that is available to investors. They're the metrics that help investors understand the potential profit on their options positions, their potential losses, and even the probabilities of success for any given position. I often use the analogy that they're kind of like the dashboard on your car. They tell you everything you need to know. Can you get somewhere without looking at the dashboard, looking out the windshield for that matter? Well, yeah, maybe, but you don't want to. All the information you need is right there when you use the Greeks.
Okay, good analogy. Bo, how do you think of the Greeks?
I honestly look at them a little differently. I look at the component parts of an option. There are, as we'll see in a couple of slides, 6 component parts that constitute a theoretical value of an option, a call and a put, and these isolated variables are Greeks. So when you isolate the value of the stock in this differential equation, this option pricing model, you get the price of stock in a call and a put combination. Manipulated the right way, it will exactly value the price of future or current stock. The 5 other components, algebraically isolated, will create a Greek. So if you isolate the strike price, you will get gamma. If you isolate time, you will get theta. Volatility, you will get vega. And that's how I look at it, as a isolated, securitized variable that produces a sensitivity. And these sensitivities will weigh on the value of the theoretical value.
Fantastic. I mean, that's why, I love it. Steve, you're next. I mean, this is why we have a panel discussion, because we get these different perspectives. How do you think of the Greeks, Steve?
Yeah, Bo just blew me away. I mean, I got to tell you, like you, Joe,
I'll be here all week.
Everybody, it's great that we can all be here. I go back to a little more basic view, especially on options house, retail and investors, brokerage. Options in their very nature are just such powerful tools to change the risk profile of straight stock ownership, right? And the Greeks allow an options trader to really gain a picture of their portfolio's changed risk profile. I mean, it's not going to be the same. It's not going to be as simple as just buy it, and if it goes up, I make money, and if it goes down, I lose money. When you are able to employ options to change that straight line risk profile of straight stock ownership, you're bringing in some added complexity, but you're also bringing in some added weapons to change that risk profile, and the Greeks allow you to get a picture of that. And we have these really smart guys that can figure out all the models and derive the equations, but the straight investor, he can just use the Greeks to gain a snapshot, to gain a profile of what their portfolio looks like at any particular time.
Okay. 3 different perspectives, different reasons, different approaches to the Greeks. I guess really we kind of answered that question, why they're important to investors. How about this whole idea of pricing models? Is that important, Bo?
A pricing model is the fundamental valuation of these 6 variables into a stock price. The stock price is a result of a differential equation, this option pricing model, this Black-Scholes or Cox-Rubinstein model that forms this call-put combination. If you do not know the basic value of the option you're trading, you're lost. There are valuations put on by the marketplace, valuations put on by historical movements and variations in the stock, and these truly have to be studied. What the history of the stock is, what the range of a stock is, what the expected move of a stock is within a finite period, and this is what the option model will give you. It gives you way more than a call and a put value. It gives you your Greeks, and your Greeks will give you the timing of a short sale of a put. It will give you the valuation of your call, your spreads, and you can use those building blocks to create a portfolio or reduce your risk and increase your yield. Sorry for the commercial, but it really does work.
Oh, that's good. Dan, in terms of the models, is it important that the average investor using options pay attention to the models, in your opinion?
Yes, absolutely. It's essential, but let's kind of take this into perspective. Kind of like Steve was alluding to earlier, I would say you definitely don't have to know how to derive the Black-Scholes model to use it effectively. I look at it as sort of like, if I open the hood of my car, I can't find anything under there. I can't fix a car, so I can't build a car, but I can drive one. So I use a pricing model every day. Every time I look at an option trade or a potential option trade, I'm always using the pricing model, getting sort of under the hood, if you will, and getting in there with all that math is not necessarily for a typical average investor, but the values that are derived from it are essential.
Anything to add, Steve?
Not really. I would just say, the outputs of the model critically important for the basic investor. But for someone who is capable to look deeper and dig deeper, that's a good thing about this whole sort of study is you can take it to any depth you want to take it. I think that perhaps would benefit you and would sort of complete your circle of understanding. But using the outputs of the model, that's important, but you can use the outputs without actually knowing how the model works. One of the greatest things in all, U.S. stock trading and options trading is you have a bid price and an ask price. So, how do you know that it's the right theoretical price of the option? Well, you know that if you're an interested buyer, you know exactly where someone else is a buyer, and you could say, well, I'm more interested than them, so I'll bid a little bit higher price than them. I'm not using any theoretical pricing model to determine that. I'm using the market mechanics that are available to each and every investor.
Well, you mentioned theoretical values. Go ahead, Bo.
Thanks, Joe. Let me just throw this out there as far as using the end result of this model. Firstly, let me see if we can draw a little line between the option pricing model, which results in a Jan 40, a series. Then there is the extrapolation of that, which will produce a matrix of Jan, May, November 40s, 50, 60, 70. So you have the entire matrix of values in front of you when you have an option chain. To my end, if you're using an option pricing model and you have a customer that's a natural seller, he might be a put seller. He likes to come into the market at a discount, let the premium work to his benefit. When would you ask him, when would you sell that put? What point can he become a less experienced put seller and qualify that judgment versus being a less experienced put seller and quantify it? So if you go to an option pricing model and all things are equal and you change your date from June 11 to June 19 to June 26, you will see a natural cliff in that put. Like all time decay, it's linear to a point and then it becomes a cliff. You can start to identify, theoretically, quantifiably, the best time to sell that put. You don't have to sell it 14 days out. You can sell it 11 days out or 9 days out when that cliff starts to appear. So to the benefit of the put sellers, a large population of the option traders, there is a tool out there that has gone under the radar and not been brought to their attention. I think that would be a marvel to start to dig in that field.
I like the whole idea and discussion in the theoretical area. I think we may come back to that, time permitting, at the end. So thanks for that, Bo. Why don't we get into these Greeks specifically? We got the delta, gamma, theta, vega, and rho. How about if Steve, I start with you when we talk about the discussion of delta.
Great. Delta. It's the first order Greek. The first derivative, it sounds cool when you use it in conversation. What kind of delta do you give that? It's got a lot of different definitions, and I would say of all the Greeks, it is definitely the most useful for the stock trader. So a stock trader first getting into trading options, they need to know what delta an option possesses, and the delta. One of the definitions of delta is the expected price change for a 1 point move in the underlying. So calls have positive delta, puts have negative deltas. If you own a call with a 50 delta and the stock goes up 1 point, theoretically, the option should increase in price by 50 cents. So sort of by definition, the delta is it's also known as the hedge ratio for professional investors and professional option market makers. But the delta really is a percentage of risk of stock ownership, of the percentage of price risk of stock ownership. So if I'm a stock trader and I want to buy a stock, but I say, you know what, these option things are pretty cool. I can limit my risk to the premium that I pay for an option, but I want to have exposure. I want to have exposure to the stock. That's my opinion about, I think the stock is going to go higher. So I would look for and use delta as a percentage of risk ownership, right? If I buy 100 delta or a 1, it's on 100 shares, so we typically call it 100 delta option, I have 100% of the risk of stock ownership. And again, delta is dynamic. It moves as price moves, it moves as time moves, and we can get into a little bit of that. But as I'm looking at it right here, right now, if I want to own the stock, I could take a look at the option chain and look at the delta column within the option chain and say, I want to have about 60 to 75% of the exposure that long stock would give me, but I'm going to be using less capital and I'm going to be hedged to the downside below that strike price that I've chosen. So it really helps you identify the strike that you want to focus in and perhaps take a position in, and you can look at it as I've got 70% of the exposure that I would have if I bought 100 shares of stock. So, by definition, you basically have a 70 delta or 70 shares of exposure, price exposure to the underlying instrument. Delta is by far the most basic, most useful Greek term. If you take away one option term from this presentation. If you're new to options, definitely let's get our head around delta.
That description, the percentage of stock ownership risk, I find very, very pointed and interesting. Dan, how about you? Do you explain delta any differently?
No, I mean the idea that it's a hedge ratio is really, really important. I mean, in my book, Trading Option Greeks, I list kind of 4 separate definitions, but really they're kind of all the same definition. I mean, the classic textbook definition is simply the rate of change of an option's value relative to a change in the underlying stock price. So stock goes up, how much does the call go up? There's the delta. The derivative of a graph of an option's value in relation to the stock price. So that's kind of like a separate sort of definition for the mathematically inclined, I guess, but really it's kind of a restatement of the first one. And then the classic definition of a hedge ratio, the equivalent of the underlying shares represented by an option position. So, hey, I own 500 shares of stock. If I want to hedge this by buying puts and get it what we call delta neutral so that my immediate risk is negated, how many puts do I have to buy? Well, we look at delta. And then finally, and I'm just going to kind of lob this one out there and not spend too much time on it, but I think it's important to throw out this one. It's the estimate, delta is the estimate of the likelihood of an option expiring in the money. Now, to be sure, yeah.
Show me that mathematically.
Yeah, exactly right.
I like it.
So, yeah. To be sure, and I think Bo and Steve can probably attest, every option trader that I've ever met uses that as a just assumed definition. Yep, that's how I use delta. However, it's not actually entirely mathematically correct. But it's a nice little rule of thumb, especially for novice traders.
Very, very rough. A 20 delta option, you have 20% chance of that option expiring in the money at expiration.
Mm-hmm.
Very rough, very dirty.
And Bo, in terms of delta, Bo?
Well, I want to talk about delta in terms of a context of Greeks. Because when we talk about options, and if you buy a call in anticipation of substituting your stock or weighing in on that value, on your valued bet, your hedged bet, what other bets are you making when you buy the call to mimic the stock? So you're also, with buying that call, you're buying gamma. You're buying the probability of it's going to move. You're buying the time. You're buying the interest rate. You're buying a dividend value. And when you start to buy options naked, you're exposing yourself to all of these 6 variables, and you can change that characteristic. You can securitize that bet, that trade, by having a spread. So if you want deltas and you like that, but you don't want to assume all the other risks of the Greeks, you can buy a vertical, thereby stripping out, meaning you'll buy a Jan 40-45, stripping out the volatility component. You're just left with the stock direction component. You're stripping out a lot of the time component by keeping it non-time valued. So this is what I want to start to explore. By buying calls and mimicking the stock, you're also assuming 4 other variable conditions that have to go your way. You're making it into a parlay. And you need to securitize that investment, securitize that trade by reducing or eliminating or exploiting another option against it to diminish or exploit that variable, that risk. So that's my idea of delta.
That's good. And, for our listeners, Bo succinctly put out there that whole idea of hedging, the various Greeks, and he used the example of the vertical spread, buying a 45 and selling a 50 to offset some of the various Greek exposures. Let's roll into another Greek. How about gamma? Dan, you want to, speak, how you think in terms of gamma?
Sure. It's important to understand that all these Greeks are dynamic. When any of the inputs into the option pricing model, by which I mean in particular the price of the underlying stock or the days to expiration or the implied volatility assumption, when any of these various variables change, delta, gamma, theta, all these Greeks we're talking about today, they change as well. And gamma is maybe kind of the easiest way to understand some of these dynamic changes. With deltas, and I don't think any of us touched on this little nuance of deltas, in the money options have rather large deltas, close to 100 at its largest. And out of the money options have small deltas. At their smallest, they can approach 0. So it's intuitive when you really start thinking about it. When the underlying stock price changes, well, options consequently get more in or out of the money. So consequently, their deltas must change. Now, especially when you're managing rather large positions, like a market maker or institutional trader or something like that, the effect of the underlying stock price changing and the effect of how the delta of those options change, it can be material. It can show up on your bottom line, and it's really important to observe. So that's what gamma does for us. Gamma is the rate of change of an option's value as the underlying stock price changes. And it's important because at any given point, I want to know what my delta is. And so when the underlying stock price changes, it recalibrates, and gamma helps me understand those changes.
Good. Bo, your approach to gamma.
Well, I always used to think of gamma as like it was just said, the rate of change of the rate of change, the slope of the change. I don't think of it like that anymore. I think of it very simply. It's the variable that is connected to the strike price. It is the solution of the variable put to an options pricing model. It comes out as gamma. So strike equals gamma. As your stock approaches the strike price, your gamma increases. As it moves away from a strike price, it decreases. So gamma is the barometer of the stock moving towards or away from a strike. Simple.
And how about in terms of proximity to expiration? Is that important, Bo?
Well,
as it
I
relates
think it
to
has
gamma?
to do. I do, because I think as the stock makes up its mind where it's going to find a home at expiration, that option will also make up its mind that it's going to go from in the money or from at the money to an in the money option. So the slope of change is going to change dramatically as expiration nears and that stock finds a price. So an at the money option, which has a huge amount of gamma, at the money calls have the widest strike and the most amount of premium. As that option starts to mature and decides it's going to go from 50 to 100, that slope increases dramatically. So as it's resting at a strike, the gamma will take off. It's all about the strike price.
Steve, anything to add?
Yeah, I would just add, Bo's explanation about strike is really valid, and it points out just one other thing that we didn't talk about was a call option with a strike of 100 has a unique gamma. The put option with the same strike, because it's all about strike, has that same gamma. Puts and calls have the same gamma. It's all about the strike price, and it's all about whether that option is going to finish in the money or out of the money, and how the delta has to change, because at expiration there aren't deltas from 0 to 100. They are either 0 delta at expiration or they're 100 delta. So in order to move those deltas, that's what gamma does for you, and the gamma is the same for put options, and it's the same for call options.
Good point. Okay, delta and gamma. We knocked them out. Bo, let's talk theta. You were talking earlier a little bit about how, each of these Greeks kind of impacts the other and hedging against the other variables. How do you approach theta?
Theta, firstly, is the largest component of an equity option. Theta and the gamma value comprise the option premium. A little bit of interest, there's a degree of dividend, but they're minuscule most times. So as we have this component, this time premium component, and I'm going to go back to a Jan 40. Doesn't matter what month we're in, but relative, just to be able to nail down a series. The time component of that stock staying at that strike will weigh very heavily on the premium of that option. So as you're making a time premium investment, you have to choose whether that stock is going to stay at the strike or move away. If your feeling is that it's going to move away, you may want to make a vertical, a vertical spread out of it, a credit spread out of it, or a debit spread, whether you're a buyer or seller. If you feel it's going to stay or move away from the strike, you don't have to worry about up or down anymore. Your only investment choice is whether it's going to go towards or away from the strike. If it's staying at the strike, you want to be a premium buyer. So you would buy a time spread. Conversely, if you think it's going to move away from the strike, you would be a premium seller, a time spread seller. Very simple. No longer an investment that has to do anything with the stock going up and down. It's now only a function of it moving away from a strike. So we're now looking at a different investment vehicle where we're not replacing our stock with options or making a hedged bet on direction. We are making a time bet whether the stock premium will expand or contract based on whether it sits and moves into that strike. That is theta.
And do you want to just give a specific example, buying versus selling around that $40 strike for our listeners?
I couldn't be happier with that question because the brokers and the customers out there may like this answer. Jan 40, let's say it's March. So you have a Jan 40 2017 leap. There may be $12 in premium to that option. $12 over and above the stock value where it's sitting today. And it may be very valued to be $12 over the value. You can buy that, replace your stock, and sell your stock. So you buy the option, you buy the year-and-a-half term leap, $15, $16 over the value of the stock, and you sell your stock out and you can recap that cash. Now, every month that goes by, you get to sell an option against your leap and take in the premium. You now have 18 cycles, if you're not a weekly trader, but 18 monthly cycles to get that premium back. You are a premium buyer. If the stock stays around the strike, you will have the privilege of selling the fattest premium against your position, hedged, reaping the benefits of a short premium sale against your long-term investment. Conversely, if you think it's moving away and you're trading a radically moving stock, a lot of gamma, a lot of variance from the mean, you can sell the long-term option and buy premium against it monthly or quarterly, offsetting your risk for a long-term call. So if you're a premium buyer, you think the stock is going to settle in, the spread's going to widen, and you can put these options out there every month and they will expire. And if you get called, sell the put. So that's the premium position of a long-term theta or short-term theta buyer.
Good. Steve, your thoughts on theta?
Yeah, I think this slide that you have up here really illustrates Bo's point really well. You can see that for, assuming at the money is around the mean there, that extended mean for the 1 week option, you can see how the decay is quite a bit. The theta is the amount of decay, the amount that the option will waste away each and every day. And with a 1 week option, obviously 1 day is a much larger percentage of the life of the option than a 3 month or a 6 month or an 18-month option. Then 1 day is a percentage of the life of that option. So you can see that the decay around price, though, remains a little more constant for longer dated options, but the decay becomes very acute if you're right at the money and it's shorter term. So what one of the, I mean, we haven't talked about specific strategies necessarily yet, but Bo alluded to, buying a longer dated option as a replacement for stock, and then selling shorter dated options which have a higher theta component, a higher decay component every day. That's a quite a popular strategy for the retail investor.
And it has worked.
With that strategy,
and it's
Steve,
had times where it doesn't work too, obviously.
Sure.
Yeah, I mean, and do you typically, if Bo was talking about the 40 strike, if you're buying time, you buy that long-term 40, are you typically selling the front month 40 call, or are you selling, a higher out of the money call, or, is there any recipe to that?
There, it comes in all sorts of flavors. Options are totally flexible. But one of the popular trades of our customers is to find a portfolio of stocks that they want to be net long in. So they buy a slightly in the money, maybe a 70, again using delta to identify the strike. 70 delta option out in time, maybe out a year. And then they sell an out-of-the-money option, again using delta to help you identify the strike, and using delta as that rough approximation of the stock finishing above that price point, above that strike. Perhaps pick a 25 delta option, so it's going to be an out-of-the-money option, out 1 month, and continue to sell an out-of-the-money option against the in-the-money option that they're long, and they're a net theta positive, meaning every day that goes by, time decay of that position, of that strategy, is working for them. And they, that's quite a popular strategy. That's a diagonal calendar spread.
Okay, great. And I think, the more specific strategies we can speak to, almost the better for our listeners. Dan, have we covered your approach to theta, or something to add?
Yeah, I mean, I can just really briefly take some things that Steve and Bo talked about and reiterate and maybe use a different example or two. I just start this with the observation that, like these guys said, as time passes, options lose their value. That's a phenomenon referred to as time decay. But on any given stock that has options listed on it, there are a lot of different options to choose from when structuring a position, right? Like in the option chain, I mean, if I want to trade options on Apple, I've got 100 different options to choose from. So the goal for any trader is always to maximize your risk reward, to always have the best trade that you can. Lose as little as possible, make as much as possible. So traders should always select an option that has sort of an optimal theta to accomplish their goals. And I don't know if this is, I guess, is a little bit different than what these guys talked about, but one perfect example is, hey, maybe I'm a premium seller, an income trader, and I want to sell a credit spread. Well, which do I sell 6 months until expiration or 1 weekend?
Dan? Can you guys hear Dan?
No, I lost Dan, but Joe, if you could go back a couple slides, you showed how theta is not linear with time as an option, and you had two graphs that showed it. One showed the comparison of different expirations, but even further back with just a single option and the life of the option as it counts down to 0. I think it's back about 4 slides, actually. It's slide 44, I believe.
It looks like the White Cliffs of Dover, I'm sure. So
This is what Bo sort of alluded to at the beginning with this cliff, right? If you're a premium seller, an income generator, you can see that we don't have dates on here for the time, but closest to the XY intercept, with the most time to go to expiration, that option's rate of decay is very slow and very gradual. And then all of a sudden the White Cliffs of Dover, I like that analogy too, Bo. You can see that at some point there's an inflection, and it's not going to be straight. It's not going to be the same point for each underlying, because each underlying, higher implied volatilities have more decay, but then they also have lower delta and more gamma. So, I mean, there's this balancing act, but you can see that as time approaches zero, the life of the option approaches zero, that decay time value one day becomes a bigger percentage, and that really accelerates. That at the money option really accelerates with its time decay each and every day. Something to be critically aware of. Go ahead, Bo.
I'm sorry, we have the tools to quantify this. When I do my seminars, I ask the experienced put sellers when they sell their puts. And I hear the most common answer is 10 to 11 days out. And I know that that's kind of a good answer, but honestly, you just click on optioneducation.org, you open an option pricing model, you change the date. That's all I'm asking you to do to practice, and you will see there is a moment in the rate of decay that accelerates quantifiably, visually. And that's where I need to start getting the customers to start to focus and not assume the other risks in the marketplace while they're trying to just reap a little bit of premium against their stock. So to that end, yes, this is an illustration of a short put seller and a theta trader using the right tools for the right timing.
Yeah. Hey, thanks, guys. My phone cut out, but I am back. Yeah.
Well, welcome back, Dan.
Yeah,
we just finished up, good conversation about that cliff that happens with theta, and I think Steve, how about if we roll into Vega or volatility? My personal favorite Greek.
Your personal favorite, huh?
Yes,
so
indeed.
Vega is the sensitivity of the option with respect to implied volatility moves, because implied volatility, again, is not going to be constant, as you will find. So if you come across an option that has earnings and implied volatility is high, because there's this unknown event that's in the near term, the implied volatility is high, the Vega will likewise increase, and the Vega will represent the options value sensitivity to that implied volatility moving either up or down. And typically after an earnings event comes out, the news is known, the stock finds its new equilibrium price, and the implied volatility will very likely, we call it a vol crush, but it'll very likely resume sort of a normal implied volatility characteristic for that underlying without an event in front of it. So again, the Greeks overall, to Dan's analogy of the dashboard on a car, it gives you a visualization of the various risks that your portfolio's, the risk profile of your portfolio. Vega is if implied volatility moves higher or lower, what is my exposure to my options portfolio's value given just moves in implied volatility? Nothing else, not moving price, not moving time, not moving anything else, just if implied volatility shifts higher or lower.
And Steve, before I roll into Dan on this, that shift of implied volatility in the levels, does that happen a lot?
Oh, that's a great point. It does when events come and go, when something changes, for a drug company, if they're having some trial that they'll know the results, obviously there's a big unknown, and so the shifts can be quite dramatic. It happens around earnings. It happens when the market was nervous in January, and the VIX and of the overall portfolios, the overall market's volatility spiked higher. But it isn't necessarily as dramatic of a change as gamma is, certainly not as delta. Theta is constant. Theta, every day it's going to have theta. You just don't know where your underlying is necessarily going to be, if it's going to be at the money or not. So Vega is more of a measure that if you are buying long-dated options and you are selling shorter-dated options, you need to take a look at your Vega of your overall portfolio. You will be Vega positive. Longer-dated options have higher sensitivities to implied vol changes. That said, longer-dated options don't change their implied volatility characteristics that as quickly as shorter-dated options.
Okay. Dan, with your approach to Vega, how do you focus on it?
Well, I mean, in many ways, definitely exactly what Steve was talking about is something that I look at, but I'll sort of introduce another concept that I think is really important. Vega can be a really great source of what I and my students refer to as edge. In its simplest form, like imagine somebody who is considering buying a call because they think a stock's going higher. So, yeah, they can potentially profit on the delta of the call if the stock does indeed go higher. They have this time decay risk, again. But then they have this other risk. They have the risk and potential reward of implied volatility changing. So traders really need to look at implied volatility before making any option trade and basically see if it's high or low, see if options are overpriced or underpriced, and let that.
How do they do that?
Well, one technique that we teach at Market Taker is to use a volatility chart. Is implied volatility today above or below historical? Is implied volatility near the top half or the bottom half of its 6-month range? And then maybe some volatility forecasting techniques as well. And then you kind of let that guide the strategy selection. If implied volatility is really, really high, like going into earnings, for example, or if it's just high and it's not earnings season, is that a time that I want to be buying options or selling options? I mean, maybe it's for earnings, maybe the answer is neither. If implied volatility is really low, is that a time when I want to be selling options to generate income? Well, probably not. Maybe it's better to be an option buyer at that point. So it helps give traders a little bit of edge and introduces a potential third source of potential profit for them.
Okay. Anything else you guys want to touch on with regards to this whole idea of Vega? I mean, so as the uncertainty in the market increases, option premiums increase and decrease, when things, I guess, maybe are a little more bullish and calm. That's fair to say, yes?
This is Bo. I think I want to put something else out there. Volatility, or Vega, the volatility component, the Vega sensitivity of an option really is more like a thermometer. And it's testing the excitement of the option. There is an opportunity to look at an option board, to look at the matrix and say that the Jan 40s may be in flavor right now, and the public is coming for them, or institutional buyers are coming for them. And there's a disintermediation. You need to look at the whole board and see where the volatility of the entire chain is trading. And if there's an opportunity to sell 41 volatility in a near month, or buy 27 volatility in a near month and sell an offset somewhere else on the board to create a hedged position and to sweat a little bit of that volatility, that spike, because it usually doesn't take the whole board at a time. There'll be an opportunity to see that there's a spike in this option. You look at the other part of the board, see if there's something more reasonable. Even a put If you buy a put, you can buy a long-term option against it, make it into a call, and then sell a call against it. You're kind of making this vertical spread synthetically, which is something for a different day, but we're creating synthetic options on the board. Buying puts in stock, you're creating calls. It gives you the privilege of selling any call on that board. So to me, volatility is more of a barometer.
And I would, just, if I could add, Joe, in order to absolutely isolate and trade volatility, trade Vega, you have to isolate out. You have to isolate all these other Greek risks out because they have a much larger. Delta will have obviously the biggest risk because if you say, "Hey, wow, I was right. I sold high implied volatility, but I was short an out of the money call and the stock went up 15%." You're going to lose money. I don't care if you were right about on the implied volatility bet that you made. So trading Vega and is sort of the professional's game, I would say. I mean, retail investors are not going to be trading multiple option. I mean, they can trade verticals, of course, but they're not going to be trading multiple option-to-option spreads and managing down all those other variables down to zero.
Every option has a sensitivity. Every option on that board has a unique sensitivity. You can securitize your investment by exploiting the sensitivities of the other options. So I don't think it's a professional's game. I think it's a professional commitment to learn about options and their sensitivities and what makes them move. So what makes an option move? What option will move on a Vega move more so than another? This is what I'm looking at. And you have to start to look at the board in terms of a flowing matrix, algebraic matrix, and start to exploit these individual moves with the appropriate synthetic option. And I don't want to get too far afield.
Now, for the retail investor, Bo, with electronics as it is, are those spreads available?
They're not available for 3/8 of a dollar, but they're available for 7 cents or 9 cents. So if you can put that spread on with a 9-cent theoretical edge to you, you now have a vertical spread or a diagonal spread or a time spread that you can start to manipulate into either a box, which is the correlating calls and puts. You can make it into a condor. You can make it into a butterfly. And then you have a trading vehicle with an edge to you to get into the investment, not at a zero net gain or a loss to you, but at a theoretical edge to you, like we were talking about before. So as far as jumping into it with a little bit of room on your side to be able to explore and exploit the entire board, yes, it is a very public and very customer-friendly opportunity. But before we leave, I want to talk about one very...
I've actually got it. Can we stay on this for just a sec, Joe?
Yeah.
Yes. I'm sorry. I'll defer.
For the other guys, I'd love your outlook on this, right? Because the thing that I've always found interesting is, and as a professional trader, you're trading, yes, every option's unique. And back in the day when I was in the pit, options didn't update quick enough so that they were all brought back into line. But regardless of that, there's this concept called skew that's in the market, and we can talk about why it exists. But if a retail investor looks at an option chain and they say, hey, look at this, the 20 delta puts are a 32 volatility when the 20 delta calls are an 18 volatility. That's 14 volatility points of edge that I could get because there's only going to be one historical volatility of this underlying. So there's 14 points of potential edge that I could be like, take a professional commitment to this and say, I'm going to sell that downside put, I'm going to buy the upside call, I'm going to book 14 points of implied volatility edge. Now, there's a reason that the puts have a higher implied volatility. There's more demand for it. I mean, and the market mechanics work. There's demand for those downside puts, and there's supply for the upside calls, and that allows that difference in implied volatility to exist. Bo and Dan, do you think that's something that a retail investor, committed to looking at the markets and managing their exposures, can actually exploit and use to their advantage?
Well, this is Dan. I would say yes and no. I mean, even the preceding discussion, I was kind of in the middle of you two. I don't think that a typical retail trader with their margin requirements and with their commission structure can trade volatility proper and certainly not take advantage of skew in the way that I think the three of us used to when we were down on the trading floor. However, that being said, whenever you take any option position, you are taking a vega position. You are taking a position in volatility. And maybe that's a secondary or tertiary concern, but you've got a vega position. So, I mean, for me and what I teach my students is to sort of let that guide them. I mean, if I'm looking at an option chain and there is a skew like you're describing, Steve, well, I don't know, maybe I'm going to think a little bit more closely about, selling call spreads versus selling put spreads. Like I want to try and take advantage of only selling when the volatility is high and only buying when the volatility is low. So, I mean, I think even skew like we're talking about, and especially, and you didn't bring this one up, Steve, the term structure volatility, the horizontal skew, that's something that retail traders can take advantage when structuring time spreads to put them on for edge or statistical advantage.
Well, listeners, I hope you appreciate it.
Can I just say one last thing about volatility, Joe?
Sure.
When we find volatility, when the marketplace finds its true volatility, the implied volatility, what the marketplace truly values is as an absolute value at that moment, we can take that volatility component, multiply it by the stock price, and get an expected range that the customer should believe the stock will trade in and out of. And it's a very simple application for volatility. It gives them a sense of whether they're buying the stock range, not the volatility range, the stock range on the high side or low side. And that is what we call a standard deviation. That is the expected deviation from the mean. And a customer is going to make his investment based on that. Would he buy, if the high end is going to be 46, would he buy the 45 Jan 45s for $4, where it's not been there? So you could start to value your investment based on the marketplace's valuation of the range, the expected range of the stock. So that is my last point about volatility.
No, Joe, I can see why Vega is your favorite Greek.
Nothing to talk about.
Right.
Well,
boring.
I appreciate the listeners hanging in there with us. I mean, this is the beauty of bringing 50 years plus of experience to the conversation. Granted, we may have lost some of you because some of that was, somewhat advanced. But, as one of the guys said earlier, if you take, one or two or three things away from our conversation, it's a win-win. So, okay, we'll wrap up Vega on that note. We've got about 5 minutes left. I got tons of questions coming in here. We haven't talked Row. Dan Passarelli, if you would give us your 1 minute on Row, we'll then go to some questions.
Yeah, real quick. Row is simply how the interest rate affects the value of your option. The long and the short of it is when interest rates rise, call prices rise. When interest rates fall, call prices and put prices fall.
Okay. Let's see. I'm going to go to questions. Here's one. In order of importance, this is obviously subjective. How would you rank the Greeks? Steve, give me your top 3 Greeks.
Most important is delta because that's your immediate price sensitivity to changes in the underlying price. Number 2 would be Vega, because you do want to know whether you have a lot of sensitivity to that implied volatility of that option moving up or down. I would caution you that don't just think that if implied volatility is high, it's a sale, because it is likely high for a reason. Markets are very good at price discovery. And number 3 would be theta. You want to keep an eye on theta to understand if the passage of time with no price movement is going to help you or hurt you.
Excellent. Bo, your thoughts on the top 3 Greeks?
Without question, number one top volatility, the number one top Greek has to be volatility. It is the unknown component, and it is the least understood until a very short time where modeling has become a true science in our business. I would take a step back from there, and then gamma. I think it's imperative to start to look at options in terms of going towards or away from a strike versus the stock going up and down. I would then start to look at theta, because it's about capturing money. Theta is a constant windfall in your account. It's every day it appears. Every day it appears. You have to use that to your benefit to be able to count on that golden ticket to be able to open for business tomorrow. My least concern of all sensitivities is delta. I don't care about my delta. All I care about is whether my option position is hedged 1-for-1 or very close to 1-for-1. I will then manage my sensitivities without my delta being a concern. I need to be hedged. I need my options to be basically 1-for-1. Time spreads, when I have my delta exposed, I can have thousands of deltas in time spreads. I don't care. So there we go.
This is what I would point out. I would point out that, Bo, you're talking about option-to-option spreads, and when you know that you've defined 100%. Your risk up front, you've defined your delta risk up front to be a certain amount, and I don't want.
No, listen to me. I don't care about delta. Don't put words in my mouth. I don't care about delta. I care about being hedged, and I will manage my sensitivities, working my positions either diagonally, vertically, or horizontally. Time, diagonals, or calendar, or verticals. That's what I care about. I don't care about delta. I care about
This is what makes a market, listeners. This is what makes a market. So, Dan, your shot at the ranking 3, and then I think hopefully time for one more question.
Yeah, I'm going to say for me and my students, people who trade in a retail account, I would say typically delta is the most important, because for most of the common option strategies traded in retail accounts that are easily tradable with Reg T margining, delta probably affects the position's value more than any of the other Greeks. Second is theta, and then vega is the third, but still extremely essential to pay attention to.
Okay, appreciate your brevity there.
Not the last point, but I'm saying that as a customer, I would start to look at time spreads as opposed to verticals. I would start to look at time premium as opposed to stock direction. And I think delta will become much less of a value to you going forward.
Okay, I'm gonna wrap it up with one last question, and I'm gonna cut us off 4 minutes from now because we could talk for 3 days. How important are theoretical values? Dan Passarelli, start us off.
Well, they're theoretically important. Now this is
and just if I may, I'm sorry for when everybody plugs in their Options House platform or whichever platform they're using, a theoretical value comes up, but that theoretical value can be drastically different from the bid-offer spread in the marketplace, and that's why I'm asking the question, Dan.
Yeah. Well, let's kind of forget about the concept of theoretical values, and I'm going to talk briefly here. We know what an option is worth. We know that it's worth between the bid and the ask, right? Because the bid is it's the highest price that somebody in the world wants to pay, and the ask is the lowest price that somebody in the world wants to pay. So we know that theoretically that option is worth somewhere between the bid and the ask. So whatever value is being shown to you in the option chain, you always have to kind of keep that in mind, because the market exists for the price discovery process. The market values options. That's sort of at the heart of capitalism. I'll kind of let these guys run with it, since we only have a couple minutes.
Okay, Bo, your thoughts? And we spoke to it, at the outset.
Well, you have a customer or an investor with thousands, if not tens or hundreds of thousands of dollars investing in a marketplace. If they don't understand what the value of their investment is, then they should be looking in a different investment vehicle. I think it's imperative they understand the value, what the marketplace is valuing their asset before they invest or divest. It's what we call on the floor trading with sheets. This is not something you do with your gut. This is high-level math that is impossible to do in your head for most, people, if not every person. And take advantage of these tools that are out there through your broker or through the OIC, or if you want to create one. But you need to go into the marketplace with a value. At that point, you can make a relative value, a relative bet against it, hedge against it, and then you have a trade. Very simple.
Simple is good. And Steve, you want to wrap us up? Take us home.
Very simple. Like Dan said, you can't spend theoretical dollars. You can accumulate theoretical edge. You can use options pricing models to get to figure out what you believe the option is worth. But the market is so good at determining value. That said, the market's good at determining home values too. And if someone told you all the time and you were constantly being berated with, hey, your house is worth $10,000 less today, it's worth $20,000 less this month, do you panic and do you sell? No, because you have a utility function for it. So the market will tell you what the market is saying that option is worth, what your position is worth. But it's up to you to stay disciplined with your trading approach and know how you value that.
It's good to wrap it up with that word. Discipline is never a bad thing. Nick, we had lots more questions, but we're out of time. Bo, Steve, and Dan, fantastic. Appreciate the conversation. Nick, I'll turn it over to you.
Gentlemen, thank you so much for your time and expertise today. And ladies and gentlemen, thank you as well for your time. We did have quite a few questions come through, as Joe mentioned, and if the panel was not able to address what you wanted to hear, we do have our investor services team here at the OIC ready to help. You can reach out to them at options@theocc.com. Today's session will be archived and accessible in a few hours using the same link you used to join us today. Additionally, as I mentioned, our webinars are available on the OIC YouTube channel, so you can review a number of options, strategies, and concepts at your own pace. Many of you also asked about further education and further reading. You can also visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading and educational opportunities. And, of course, make sure to check optionseducation.org in the upcoming weeks for our next online and in-person sessions. Our next two webinars will be held on April 19th and April 26th, when we'll be tackling the topic of income strategies. You don't want to miss that. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.